Hello, everybody, and thank you very much for joining us today. There have been a number of political and economic events that have taken place since the start of the year, and we thought that we would just touch sides with you and give you some context as to what has happened and how that could have affected you since the start of this year. In our normal course of business, we are sitting with our clients on a regular basis, and over the last couple of months, we're starting to notice the level of anxiety their clients are showing is increasing slightly. Many of them are asking questions about the war in the Ukraine and are very worried about what is happening there. They're asking us whether we believe that Putin will go all the way to Poland. They're asking us if he will cut off the gas to Germany, the powerhouse of the European economy, and whether he will hit the nuclear button. And the honest answer to that is, we don't know. We don't know. As financial planners, we don't know. And if we fill this room with political analysts, historians, military experts, I think after an hour, the conclusion of that grouping would also be that they don't know what Putin is going to do in the end. And the reason that we're actually doing this webinar today is just to point out to you that the war in the Ukraine is not the driver of markets coming down since the start of January, and markets having coming down since the start of January. Because what markets and economies and economists and asset managers are worried about is inflation. They are worried that 350 million Americans, the great consumer of the world, are facing inflation rates of between 8 and potentially in time 10% for the first time in 30 or 40 years. This is a massive event. And this is what is driving markets and scaring people within markets. Now, inflation rates have actually been increasing since around 2020 in COVID. In that time, first of all, the Chinese, and then followed by Donald Trump in America, announced massive stimulus packages to initially do infrastructure projects, but then those stimulus packages kept getting bigger, and they were suddenly giving money to people that didn't even need money. And then those people took that money. Americans took that money and they invested it in the stock market. Some went out and bought goods, some put it in the stock market, and some went and bought cryptocurrencies. So the place was awash with money, and that has driven up inflation over time. Now, South Africa, when they announced those infrastructure projects, were massive beneficiaries of this, because out of nowhere, where we couldn't see a way out of how we were going to deal with COVID, suddenly turned around and the resource companies were making super normal profits. And the great thing about that is that they have to pay tax in South Africa. So they paid their company tax in South Africa, and suddenly SARS had more money than it ever dreamt of in such a tough period. The oil price too has gone up, and you could attribute this last run up in the oil price to the crisis or the war in the Ukraine. But the oil price had been increasing steadily, and it is now at a level of $130, which is an unsustainable level for the capitalist world to actually function on. It needs to get well below the $100 mark for businesses to be able to cope with that price. The other point was in the supply chain. Now, if America is the great consumer of the world, then China is the great manufacturer of the world. And they had a very, very hard lockdown initially, which completely, all factories closed, nobody was going anywhere. And as a result, the world, nothing was actually getting produced. Also, it had knock-on effects to the microchip business. Microchips are in cell phones, computers, cars, And now there are only 3 factories in the world. They're very high tech. One of them burnt down, and the other 2, it's taken quite a while for them to actually get going. But now that China, so everyone, including the Federal Reserve in America, believed that these were just short-term supply chain problems and they would get fixed, and that's where the inflation was coming from. But in actual fact, now that the supply chain has been hurt again because COVID has re-emerged in China, it is now a much longer term problem than the Fed initially thought they were going to deal with. Of course, where the Ukraine does come in is on agricultural prices. It is a massive producer of wheat and sunflower, to name a few, and you'll see that the shock in prices and how high they all went up. You'll also notice that in the wheat and the sunflower, where the prices have come down, but they're still 100% higher than where they were. And this will have a knock-on effect globally to all food prices around the world. So how do you deal with inflation? So it's where central banks will now step in and have been stepping in for the last 6 months, 5 or 6 months, and increasing interest rates slowly over time. And you might wonder, why does that make a difference? Well, it makes a difference because if you have a home loan and other debts, and let's say it costs you 10,000 Rand a month to pay off from your disposable income, and you pay that money to pay the debts off, and they put up interest rates, and your debt repayment now becomes 11,000, and then they put them up again, 12,000, and again 13,000, and again 14,000. You look back in a year from now, and suddenly somebody who had 14,000 or 4,000 Rand a month that they were spending in discretionary spending into the economy are now being forced to give it to the bank to hold on to their house and their cars. So that is why putting up in interest rates slows economy, but it doesn't happen instantaneously. But they have all signaled, all central banks, Federal Reserves, reserve banks around the world have now signaled that they will continue to put interest rates up. But as you'll see, the interest rates are extremely low, historically low. And all that's happening is that they're actually normalizing those interest rates. Just to give you a sense what's happening in stock markets, I'm just looking at the red line here. The red line is the global share index in rands, and you see how dramatically it has fallen over the past, since the start of the year, since the 1st of January. And initially, you see well before the war in the Ukraine, how those prices have actually come off. If you looked at this in dollars, it is now off 17%. So it's a huge knock that the markets have taken. The JSE is the purple line, and this is in rands. And it's actually only been off around 6.5% since the start of the year. So South Africa has not been punished to the same extent as international markets. And the real inflation, I'm just going to recap just to go back over it in case we're going too quickly. So the real enemy here is inflation. So the US consumer is facing a first time in 30 or 40 years an inflation rate of around 8% currently. What have they done? They've gone and increased interest rates to cool the consumer down and hopefully to cool prices down as a result of that. So how are markets reacting and how are asset managers reacting to what's going on? So there's a fundamental change now that interest rates are going back up. Interest rates have stayed low pretty much for the last 10 or 12 years. Interest rates were pushed down further in COVID, and now they're basically on their way back up to normalizing. But some people believed that that was going to continue for much longer. So what asset managers are doing now is when they look at their portfolios, they're kind of going, well, who were the companies that benefited from the low interest rates? Well, in general, they were the tech companies. They were the ones that benefited. So asset managers now are either thinking of selling them or lightening their holding in those companies. Still good companies, but the share prices are probably reflecting a much more a world where interest rates were going to stay lower for longer. On the other side, the reality is, well, what companies and sectors would benefit from higher interest rates? And as by way of an example, banks do. So a bank, as they increase interest rates, can make more and more. There's more room for them to make a little bit more margin as the interest rates go back up. So banks become way more profitable than they were in extremely low an interest rate environment. So what's happening now is that there are big changes and big rotations going on in portfolios. And just to give you a sense of like the drama that has been taking place quietly in markets over the last 12 months is that PayPal and Netflix have lost 2/3 of their value. Walt Disney is down 40%. Facebook and Amazon down 1/3. Intel and Twitter down 26-27%. These are very strong companies that are doing really well. It's just that their share prices seemed to have run ahead of itself. In general, what has happened in markets? Well, when things go badly, people hold gold, and gold gives you a tiny little return. When interest rates go up, you lose money in government bonds. How is the index done? This is what the index has done to early May. It's now down around -17%. Global growth is down further. Quality stocks in South Africa, we would call quality stocks. The old term was a blue chip shares, good management, good balance sheet, good products, good markets for them, but just share prices have been rewarded for the last 10 years. And now, as the market corrects, they are reverting to the mean. The managers and style of management that has been punished for the last 8 years, and the gap had never been bigger, was value managers. And now we're seeing that value managers are not getting punished as much as these others are doing. And then emerging markets are down around 16% since the start of the year. So what's going on with managers? And this is a global, just looking at global managers. And here we're looking at a bunch of managers that have got the same style. And these managers have done the best. And they are the value managers and the contrarian managers. The managers in here, the quality managers and the indices, they've been punished more over time. But they have been the ones that have been rewarded the most over the last 10 years. Still not bad managers, any of them. A bit like the value guys weren't bad managers 7 or 8 years ago either. Emerging markets over the last year down around 28%. And then Baillie Gifford is down around 40%. And that is a manager that 12 to 18 months ago was giving a return of 100% in dollars. So it was seriously overpriced and the market got way ahead of itself. Now here's a surprising piece of research that a research house that we use, Fundhouse, have gone out and they interview all asset managers, and both here, this research will be really from the South African perspective. And they asked them, with a 10-year view, how do you think South African equity will do against the US market in rands, the world market, emerging markets? And they believe, surprisingly, that South African equity is going to do better than all other international equities. They believe that SA bonds is going to outperform US bonds and UK bonds. And they believe that South African property, although they're not positive on it, will also, for the moment, will also outperform global property. And you say, well, how is that possible? I mean, South Africa, the lights don't even work. Well, here is looking at valuations, and this is the PE, the price to earnings valuation, and it shows if it's high, it means that it's expensive. And this gray line up here is the American S&P 500, the broad index in America. You see that the PE was at around 22, and it's now dropped down to around 18. The blue line is every other country in the world, every other stock market in the world, excluding America. And you see, well, that's not overly priced. You'll also see that emerging markets are have come off, but they are also not overly priced at a PE of around 11 or 12. But here is the interesting one, and here is the answer to why South Africa could possibly and probably do better than the rest of the world over the next 10 years, is because our price to earnings ratio is incredibly cheap and is at what is considered a massive discount at 9%. It should be somewhere at around 14 on a normal trading basis. So that is why they believe that South African equity is going to do well over the next 10 years, and South Africa in general. So what happens in portfolios? What do you want to see in your portfolios? You want to see a slightly underweight towards America for the moment, a slightly underweight towards global growth and global quality, those blue chip stocks. You want to have less of those just for the moment while the market re-rates itself. You want to have an overweight position in global value, and you want to have an overweight position in emerging markets. And in South Africa, you want to hold your full allocation of South African equity and South African bonds. So I'm sure that would be a surprise to many of you to see that. There are fundamental changes that have actually taken place in the markets now. We're in a different cycle. We were in low interest rates where people benefited for a very long time. We're now in a different dynamic of higher inflation and higher interest rates. And as a result, there's quite a lot of work being done by the asset managers within your portfolios on a daily basis to reposition them, to try and take advantage of what can happen now in the next 10 years or so. So thank you very much for listening. I hope it was interesting. We would love to get some feedback on it, on this medium, and how we could do it better. But thank you for listening. See you soon. Bye-bye.